And so, thinking about your strategy, how do you handicap risk beyond the fact that, the trades could go against you for any number of irrational reasons for any period of time? How do you handicap risk in the meantime, if at all? And then more generally, how do you handicap risk at Gotham to sort of sustain your performance?
Oh, sure. So I left out something. That beautiful chart I showed you with the, upper left-hand corner making so much money and the right-hand corner, and I asked that question, of my students, and I said if they didn't say I'd buy the upper left-hand corner and short the bottom right-hand corner, I'd throw them out of class. I wasn't exactly being straight, because if you literally did that, you put $1 in the top corner and you shorted $1 in the bottom corner, you wouldn't have any money left. If we hit another year like the year 2000, when rational thinking was thrown out for a period of a year or two, you would have lost so much money, you would have been down to zero, and zero doesn't compound very well. Okay, so your question's very important. Risk management. How do we balance these two? So we always buy the cheapest, short the most expensive, subject to risk constraints. So we're trying to balance these two sides in various ways. We make sure our betas aren't mismatched. We make sure we don't have too big a mismatch within industry groups or types of companies. And that's just prudent, not because so we buy the cheapest, short the most expensive, subject to risk constraints is really what we're doing all the time. We're trying to balance those risks really to get to the long term. The long term was that chart, and that chart was 1 year forward, so usually you don't have to be that patient, but sometimes you do. Sometimes there are 2-3 year period where it's not rewarded, and if we were, as I said in the beginning, momentum investors, I would start worrying whether this is a crowded trade. It's correlated with good returns in the past, but it may not in the future. But if we're actually viewing stocks as ownership shares of businesses that we value and buy at a discount, what I promise my students, what I believe. The market will eventually get it right. I can't tell you exactly when, but it will. That's what stocks are. Ben Graham said the market is a weighing machine. It's a voting machine, which means it's emotional in the short term. But it's a weighing machine in the long term, meaning, the truth comes out. That chart sort of shows that it does, but it makes the ride look much smoother than it actually is. So you have to be able to withstand those times and realize what you're doing. We're valuing companies like you'd buy a house. You're not going to all of a sudden, have an investing strategy. If you just think about how silly some of these things are, like if you told someone you're, just going to go around the neighborhood and buy the houses that are up the most in the last month, people would think you're kind of, maybe not the brightest. I
have a house to sell you.
Yeah. So people, but when they come to stocks and you get prices daily, and people come up with all kinds of crazy things that they think will work, and they may. But valuing a business is really what stocks are. It's an ownership share of a business, and that's what you really come down to.